Everyone, welcome to the Big Market Debate. I have with me Mr. Prakash Diwan Head, ALTAMOUNT Capital Management, and Mr. Hemen Kapadia, founder, chartpundit.com. Welcome to the webinar, sir. My first question is for Mr. Prakash Diwan. So we have been talking about, we anticipated a sharp recovery in the economic growth, but now it seems to have hit a roadblock. Under current scenario, when we are facing, rising infections, what is the kind of impact that you see on our GDP numbers, and how do you expect the markets to behave here on?
So thanks, Yitu, for having me on this webinar. The sad part about the impact on the economy is that we are as ill-prepared on the economic front as much as we were on the healthcare front. Nobody anticipated the second wave to be so severe and so quick. It's kind of suddenly come on to us starting off just as recently as in March, and in April we have some very devastating impact and effect that we are reeling under. So my sense is that the actual economy, the impact on the economy is going to be felt with a little bit of a lag, but it could be much harsher than what we saw last time around. The lockdown last year was something that we got over fairly well, I would say. Given the fact that there was a lot of resilience, and the spread of the pandemic was also lower. So specifically, if you ask me, there's going to be a significant impact on the availability of skilled and unskilled, semi-skilled manpower itself. So sectors that will get impacted are the ones that need a high incidence of labor, high incidence of skilled manpower. So it could be your fabrication units, your auto assembly lines, it could be a lot of textile units. So wherever there's a mass of people working towards something, and there's no work from home possible in some of these segments, as you know, right? We're not talking about IT, we're not talking about financial services. And that's where I think the impact is going to be severe, and that means it will have a cascade negative impact on banking, on NBFCs, because end of the day, when you have oxygen shortages and you shut the tap for industrial oxygen to go, the first impact is felt by the SMEs, the ones that use industrial oxygen to fabricate and put together their products. And if that is not going to happen, the ability to pay back loans on time and all is going to be. So I think it's a fairly significant impact that will start happening with a lag, and that's why we've still not been able to anticipate, because we don't know the finite timelines for this second wave itself.
Hemen, do you expect a tug of war for Nifty direction in next few weeks? Because, what sense do you make of the heightened volatility that we are seeing in the markets right now?
Very valid question, Thank you for having me. I guess you hit the nail on the head. It's been not exactly a paradox, but yeah, traditionally the US leads the world. You have France doing well, you have Germany doing well, and unfortunately, obviously, the COVID tragedy has hit all of us very badly. The Nifty has been range bound with a negative bias for the last 10 weeks, Agito. So it's a large range, but the thing is, the bottoms keep on dropping. I mean, we had earlier around 14.6, then 14.4, then 14.250, and now we've broken 14.250. We've closed above that. So it's been dropping 10 weeks and counting. Well, the US VIX has been very mild. It used to be below 18, I think, just because of rumors of a hike in corporate tax in the US. Dow Jones crashed and corrected, and the VIX went up over there. But here it's been slightly elevated at 23. But one important thing to point out, last time we were at 14 to a few weeks back, not last week, a few weeks back, the VIX was 29 and we are at 23. So some hope and a cushion for the bulls, but directionally, one, we've gone nowhere after 10 weeks. And secondly, frankly speaking, the Bank Nifty has a decent weightage on the Nifty, Gitu. So now that has been distinctly negative. We've been down for 10 weeks in a row. And first time after 10 weeks, we're seeing the first technical green shoots. Maybe it's a bit premature, maybe we're jumping the gun, but one gets the feeling that the downward momentum seems to have slowed down and we are getting into a sideways consolidation. If that is the case, after maybe 5 to 7 trading session, the next thing will be up. So depending on how the bank nifty performed, which up till now has been underperforming, now seems to be stabilizing.
For financials, Prakash, do you think growth is a bigger overhang than the asset quality?
Yes, so I think we ended up over gearing ourselves, over preparing ourselves in the previous years setback or slowdown, and the forbearance that the RBI actually advocated and the banks adopted was fairly liberal, commensurate given the gravity of the situation, which was not as intense as I said likely in the second wave. Because remember, while the urban engine was slowing down last year, the rural side was still contributing in a lot of ways. This time around, it's even tier 2, tier 3 cities that have got impacted, right? And that's where largely India resides. So I think the quality of the NPA accretion that could begin is a fairly new cycle, and a lot of financials, a lot of NBFCs, and particularly the ones that are SME focused, will probably reel under this impact. Because how long can you keep on waiving of interest? How long can you keep on deferring the repayment schedule? So it's going to be fairly difficult. Balance sheets will get stretched. Provided the only saving grace out there could probably be if the pandemic, if the second wave actually doesn't go or extend beyond what's within the realm of control, and if that can get controlled, possibly you will have a couple of bad quarters. New NPA creation probably surfaces again. And I would be surprised if MFIs start seeing the stress develop in the first phase. That comes onto the SME lenders, and then it comes to the larger banks. It's the larger corporates who are still resilient enough, Gitu. So my expectation is that corporate-facing banks might still get away with it. But the smaller NBFCs, which are very, very rural-centric, very SME-centric, might have to pay the price.
Hemen, you just spoke about, banking might see a bit of rebound as far as the technicals are concerned. If so happens, which are the banks that would see some bit of a recovery, and which are the ones that would lag it?
Well, traditionally, if you see, the PSUs have been lagging, Gitu. And despite intermittent spurts or, technical positive flashes that one would hope that, yes, finally we've turned the corner, but they still continue to lag. If you go historically, I think it's always been HDFC Bank, which has been a bulwark and have been leading the market. So it's HDFC Bank, Kotak, and then the ICICIs and the Axis. This is from a technical point of view. So as of now, I believe these banks should do better, but I think something like a City Union Bank. City Union Bank hasn't done anything much, Gitu, but so the mechanical indicators have turned positive. The stock looks promising. Above 168, it could serve. To play it safe, I would probably start with the ICICI or Kotak. And yes, if you want to do a contra trade, a contra in the sense, because PSUs, whether you get BOB, you look at PNB, or you get Can Bank, all of those, I think most of these are also FNO segment participants, Gitu. They've been down, but I think State Bank, I think that leads the PSU bank brigade. So State Bank just seems to be stabilizing. If in the next week, by the next weekend, if 320 doesn't break, chances are that State Bank should start participating once again after 9 weeks. So to play it safe, it would be a Kotak, HDFC, or a City Union Bank. From the PSU pack, I think State Bank is clearly head and shoulder better than the rest of the PSU stocks, bank stocks. Either.
Prakash, what's your view on the metal space? Metal has been given a big surprise in terms of price performance and the way the pricing has been increasing for the products that they have been selling all around the world. So what is your view on metals? Should one be a buyer in metals at these current levels also, or should wait for a decent correction to get into it once again?
No, so yeah, I understand. That's a very valid question, given the fact that a lot of people have this feeling of having missed out on the metal rally. A big part of it, especially which started early 2020 or probably late 2019, if you would. We would have to thank China for the first half of the metal rally. And when I say first half, that means there's a second half still to go. Okay, so to answer your question specifically, if somebody were to get into metals now on a selective basis, there could still be some money left on the table. but it might not be as promising, as rewarding as what we've already seen in the last 18 months, because the first 18 months of this rally, and typically metal cycles last for at least about 24 to 36 months easily. Every industry has a cycle which keeps on getting repeated, and anecdotally, if you would see, the duration remains more or less constant. So sugar is an 18-month cycle, metals is usually a 36-month cycle, paper is usually a 12-month cycle. So, these things happen. And my sense is the next leg of the metal rally, if Gitu, would probably be driven by the demand side. First was supply. The constricted supply from China actually created the price bubble that you saw. Now it's the demand side, because the US is going to be doing a lot of expansion on its infrastructure spends. And the US doesn't create its own metal or manufacture its own metal. It relies a lot on China and the likes. We haven't been, getting much of metals from China, and we started producing our own. And that's exactly why we've seen a significant deleverage happen in all balance sheets on metal players. So what they've done is they've utilized this price performance to make decent profits, write off their debts, and become much leaner. So, and all the capacity expansion, if you see in the previous cycle, which happened in metals, where the banks have lent and have a lot of NPAs. You recall, there were so many NPAs from the likes of JSW, JSPL, which banks always cried horse on. Now, those have started helping them, because all the capacities have started working in their favor. So the next round is going to be a bit tricky. Metals will give you some delta, some alpha in your portfolio as well. The delta is because of the price difference that exists in Europe and in India, let's say. There's significant amount of money to be made. It will be companies that have still got capacities and they can ramp up very quickly. And that would mean a lot of mid-sized players also. It's not just the Steel Authority of India or a Tata Steel that you have to look at, because they're well discovered. The pricing has all, the PE expansion has happened. There are metal companies, smaller metal companies. Let's say, I'll give an example. It's just an example, not a recommendation. A company called Godavari Power Ispat. So it's made all-time highs after a long time. It's consolidated, and even can actually comment on the levels that you could look at, and it's breaking out of that range for the first time and making new historic highs. Given the fact that it has a very integrated value chain presence, so it is in mines, it's in seasoning of in the intermediate side of the metal production, and of course the end results and output also. So. You will have to look for slightly more stock specific stories, but there is some respite that could be still there. It's not yet over, but it will mean the number of stocks is fewer and the quantum of upside would probably be slightly lower, but it's still there.
So any names that you would like to suggest?
I think that's interesting, because it becomes difficult to just go and pick any metal company and expect it to do well.
Any pocket of strength that you see in auto space, Hemen? Because auto has been a sector which has not been performing well as far as the price momentum is concerned. Though the demand scenario has been it has been improving, but price correction that we saw, it is not picking up at all.
Yes, I think absolutely right, Gitu. But I guess the time has come to take a slightly contra view on auto. I think if you look at the Nifty Auto Index, once again, first signs of stabilizing coming in. Okay, the downward momentum seems to have slowed down and almost stopped. So now we flatten. And the next thing is like you're taking a U-turn. You've gone to second gear, and now once you take the U-turn, you'll go back to third gear. So I guess we are taking baby steps, but yes, we seem to be around there. And if we were to talk about individual stocks, Gitu, I think Bajaj Auto seems to be the strongest of the lot. I guess Hero Honda got affected because of its factory shutdown news. But even then, on technical parameters, Hero Honda is going to play catch up. But I guess it's Bajaj Auto and Maruti which are looking promising. So I'm not saying they're making a new high or we're going to have a runaway rally through the roof. But yes, one, they rose for two. We've seen, at the risk of sounding a bit technical, we've seen positive divergences, crossover by some of the mechanical indicators, and a test of some of the important moving averages. So the way I see it is going to be, yes, Bajaj Auto, Maruti, TVS, Ashok Leyland, and Tata Motors has been relatively strong than the rest of the market. How would I say relatively strong? We've gone from 100 to 200. We need a time price retracement. That hasn't come. The time has come, price hasn't. So I guess this undercurrent is strong. So yes, time to take a contra call on auto. I'm playing for a bounce, but a significant bounce. I think a bounce would be around 7 to 8% from current levels in the next 4 to 6 weeks.
Prakash, which vertical of the auto space would you be liking the most? I mean, four-wheelers, two-wheelers, or commercial vehicles?
Sorry, I lost your audio a bit, Gitu.
Which vertical of the auto space, like two-wheelers, four-wheelers, or commercial vehicles,
Yeah.
would you like the most?
So I kind of agree with the Hemen's view that a lot of these two-wheelers are fairly finding it fairly difficult to grow from where they are, like Eicher, Hero. One is the supply side issues that they have about raw material. I mean, this chips that go into it. In fact, JLR is a slowdown or shutdown of one of its plants in the UK primarily because of that shortage. And I think that's a problem that is going to hit our auto OEMs as well. So if I had to play that part, I would go with some of the auto ancillaries, Gitu, because especially the ones that are export oriented and where they would continue to have multiple buyers of their inventory and not depend on just a particular OEM. And one of the best areas to play auto cycles favorably is tires. What happens is even if vehicles don't get used, even if they're lying where they are, the tires keep on aging. They have a biological life, and the wear and tear might not be as severe. The weathering is very high, even if it's parked. In fact, it's more if the vehicle is stationary, and you would have to replace those tires even if you didn't use them. So that's an area where most of the Indian players have started getting a lot of economies of scale, particularly Apollo, SEAT. So I would take a little bit of a exposure to that. I know SEAT is not usually talked about in a very great this thing, light in terms of its balance sheet issues, the leverage that it has, but the deleveraging that is happening in all auto ancillary and other cyclicals, there could be some deleveraging which will help favorably out here. So that would be one. And on the global scale, I think if you had to play global ancillaries, one of the best ways to do that is a small company called Suprajit. It's mid cap, it's not very large, but they're leaders in their segment and have a fairly strong capital allocation policy, expanded right on time. Good, very good promoters as well. So I think that could also do well. But these are long term bets. There's nothing which is going to happen just within a few weeks or months.
Hemen, your view on FMCG space. Do you like some companies in the FMCG space? I mean, ITC did well, but it couldn't hold on to the higher levels. HUL is moving in a range. Dabur is doing well. Any specific stock that you like the most as far as the technicals are concerned?
Yes, the Nifty FMCG posted a fresh all-time high, Gitu. And like you said, it's lever right at the forefront, but Dabur has very validly pointed out, Dabur has been the strongest of the lot because it's posted a fresh all-time high and sustained. So I believe as long as Dabur remains above 552, chances are that we'll be going towards 620 and 650. Jack in the box or the surprise could be something like a Britannia. It's not come close to its earlier high. We've been corrected for around 7 months, but now it's beginning to shape up well. So yes, the FMCG index is mildly overbought, so we could be seeing a bout of turbulence. But yes, lever leads, but Dabur is the strongest, and I think if I were to pick and choose, I think Britannia simply because of technical underperformance, and I think it will be a catch up. So Britannia could be stock to pick, I guess.
Prakash, do you think RBI will have a tough time dealing with inflation, which is now ruling at around 8-year high? Or do you expect RBI to really maintain its accommodative stance for some more time, seeing the current situation that we are going through? Under such circumstances, what will happen to the interest rate sensitive sectors like real estate, which had just started performing, and green shoots were seen there? So you view on largely on the real estate sector. I mean, Is it really going to survive now?
Yes, interesting question because the RBI is certainly walking a tightrope as far as balancing interest rates and liquidity supply is concerned, and the RBI governor actually went that extra mile to explain or trying to convince the market that they will continue with that accommodative stance because the math doesn't work in their favor at this point in time. If the government's revenues are going to be lower, much lower because of low productivity and slowdown, and inflation keeps on rearing its ugly head. There's not much you can do if the math is not in your favor. But what I think has changed to this time around in the budget is that the government has finally opened up or across that Lakshman Rekha of that fiscal deficit expansion. They have given kept that on the side and not kind of got very worked up about it. And that's one of the reasons why the RBI also would kind of go in sync with that and expand the balance sheet of for itself, which means they would probably keep on generating liquidity and infusing liquidity in the market to the extent they can, and which doesn't have a long-term impact. So if you recall, some time back there was a provision to increase small savings rate, and then that order was taken back. Now, that is very clearly an indication of the intent. It's a matter of when it happens, not if it happens, right? So interest rates hardening at some level, at some tier of the economy is likely to happen. Whether it happens to borrowers in the corporate side or not, we don't know. But the cost of funds is going to go up, and that's why the government is trying to lower the payout. Clear indication. So, coming back to how it impacts some of the sectors, fortunately, we are not in a borrowing mode. No corporate has still got capacity utilization, which is larger, in larger segments like cement and telecom and all of those, that they need to borrow too much. And one of the other things that's happening is that the growth orientation is more skewed towards exports, which means that if you were to borrow externally through ECBs, you have a very naturally hedged kind of a position where you borrow in foreign currency and you also generate foreign currency because of the virtue of your business, and you repay that. So that is helping the likes of a lot of these businesses which are expanding. But the ones that are not expanding don't need to expand because they still have capacity. So I think that's a fortunate situation actually for the time being. Where the pressure could come up is individual borrowings, and that's one of the reasons where small businesses will have to borrow money. They've run out of income, suddenly drying out of savings and reserves. Where do they go? They will have to borrow, and that's why your gold finance companies will do very well. Real estate is definitely on the upswing, more because people have started finally taking decisions which they have been fence sitting on for so many years about buying real estate of their own. Given the uncertainty, people have gone back to their hometowns. They've started looking at bigger places because if it's work from home and if you're still drawing your salary from the IT segment in Bangalore, in Hyderabad, in Pune, you don't mind taking up a 3-bedroom place where you could have done with 2 because you're working from home now. So, so that expansion is happening selectively in certain locations, not across the board for sure. And the best way to play that is, so I think interest rates will not hamper that. We are actually sitting at the lowest cost of borrowing for housing loans historically, right? And that if that continues for another 6 months to a year, I think that sector will definitely keep itself very, very abuzz with a lot of activity. And that's the way the best way to play that is through the cement and home improvement, home building products and all of those, rather than pure real estate plays. Real estate plays become very location specific, whereas a cement manufacturer will have its output being absorbed in any location in India wherever it's required. So that way you have much better traction for your output. But to answer your question, yes, there is a tightrope that the RBI is walking. Inflation will probably keep on going up, and that means there will be some impact on interest rates for sure.
Even when we talk about interest rates going up and inflation going up, we talk about bullions. What's your view on gold and silver? Is it the time to really accumulate them? Because we saw a good run up last year. Now, as fall also and consolidations now seen on the charts, what is expected?
I'm not a wealth planner, but I always believe that if you're doing an SIP, do a large cap, do a mid cap, do a small cap, and at least put some in a gold ETF. We don't have a silver ETF, but I think gold ETF is a must. And like you said, internationally, gold has come off from almost $2,090 to a low of around 1672. So we saw a scintillating rally, I guess, after almost what 8 years of doing nothing. We posted a fresh high. I believe it's also the fresh all-time high, and we saw significant time price retracement. So to read this technically, we do two things. At least an intermediate bottom has been made. So the medium-term charts, gold has posted a bottom. Levels to watch: $1776, 1706. Simply put, I think yes, gold can be considered again. We've had a significant correction and now we are stabilizing. So the next move should be up. I believe the upward journey has started. Maybe there could be a little bit more permutation combinations in terms of adjustments left, but yes, it looks good enough. And if people have the inclination for bullion, like you said, on technical parameters, I believe silver looks a shade better than gold, but I guess you have to buy it physically.
Prakash, two sectors that performed quite well in last financial year, IT and pharma. What do you expect of them this year? Because numbers have been brilliant for the IT companies, though there has been a stock correction for most of them. And pharma numbers are expected to be very good. So these two sectors, what is your view and which are the best picks that you would recommend?
Sure. No, I think let me take pharma first, Gitu, because that's the flavor of the month and like the more rocking sector of sorts, which people have still got more under ownership relatively. Pharma. What's happened is the last 7-8 years, we have seen most Indian companies having to compete with larger players in the US. The US was the ultimate market that everybody wanted to go into, and when you sell generics in a very competitive, price sensitive market, there's not much you can make unless you have scale. So most companies kept on building scales, but that was not very profitable. Now what has happened is that they have and over the years you saw the number of EIRs, the US FDA inspections that were carried out and the kind of issues that came out. It's been a very painful curve for most Indian pharma players to go up the quality side. Okay, we took things for granted. That chalta hai attitude, that whole thing of saying, okay, how does it matter? And they paid the price for it, including some of the best names in the business, like the Reddy's and the DVs of the world also had EIRs, which brought things down. Lupin, Sun, you name it, and it was there. Now what's happened is the companies have realized that if they were to focus rather in terms of mass generics in the US, which is always going to be having a pricing pressure from the government because the government spends out there, it's not individuals who are going to buy. You would rather do specialty, and in that specialty, so what happens is when the margins on your end product are lower, you keep on going backward onto the value chain and making parts of the raw material side, and that's how API happened. Our dependence on China was so high that China was the API factory of the world. We were the formulation guys and US was the consumer. This is how it worked. Now all that has got disrupted. So anybody who is part of the value chain as much as possible, right from API to formulations within India itself, is benefiting, because at every stage, thoda margin karke you add up. That's the game. And if you look at some of these names like Cipla, which is one of my favorites because of a very strong global presence, distribution, very strong ethical processes and standards that they follow on the quality side. And they have a respiratory portfolio, which is the largest by far in all Indian companies. They are not so much into oncology and other therapeutics, but they're more into respiratory. Now, respiratory is something which after COVID is going to be having a huge tail in terms of side effects. I mean, you could have survived COVID, gotten okay, but after 6 months, your lungs might still need treatment, and your body would need those kind of this, and that respiratory portfolio is going to hold them in some amazing state. So I think that's one of the few companies that will benefit out of that. The other segment is the API side. So if you buy one which is a large formulation focused, end product focused company, the other side you could look at something which is more into API. And there is a huge choice out there. I recommend to people to buy into a pharma fund because what's happening is there are too many companies to buy into, and some of them are very promising. Some of them could probably take longer to deliver, but the likes of Alembic and all are looking at doing amazing stuff on R&D. So incidentally, Alembic Pharma spends it's the second highest spender on R&D after Gland Pharma in the Indian context. So they have a pipeline that will get monetized, but you have to have patience with this. Pharma is not something which is very quick. So that's the story on pharma. But I think it's here to stay. And just to give you a last point on this, the pharma contribution, the Nifty Pharma as a percentage of the Nifty 500 in terms of its market cap has actually gone up 4 times in the last 10 years. So what it tells you is that pharma is getting more and more prominent in the overall scheme of things, and that is a trend that very rightfully you caught. IT, on the other hand, is going through a second phase of growth for us. The first phase, which started in 2000, the Y2K solutions, and gave us prominence, gave us relationships, access to a lot of clients. We did 10 years of IT and ITES. Okay, we were the back office to the world, and you remember how from 2000 to 2010 was glory years for most IT players. And then after 2010, we lost our listing way somewhere because we were not specialized on anything. That specialization has come in the form of digitization, and a lot of Indian companies which started towards digitization. So what it means is digitization is nothing but replacing physical process points with something which you can do on a computer, on a laptop, or virtually. That's what it means. Whether it's buying something, whether it's getting treated, or whatever it is. And digitization, I think, as a mantra will hold us in good stead because the rest of the world still needs to digitize. And it's just about 14% that businesses that have adapted to it. So I think it's going to be a great journey for the next 10 years. We will have enough work. We will have probably a shortage of manpower, skilled manpower to supply for these IT companies. And that's going to be a limitation. So nowadays, I was telling somebody the other day that instead of looking at asking the business development head in an IT company, कि आपका business कैसा होगा, you should ask the HR head saying, आप recruit कहाँ से करोगे? So the focus is going to shift. But specifically, I think companies like Mindtree, Mindtree is also done well, but I would say Happiest Mind, for example, which is a pure digital focused company, digitization focused company. It does 95% revenue from there. It's small as compared to the larger ones, but I think if you get it on dips, you can certainly buy it. And then you have the likes of KPIT and all, which are very specialized in EV technology, EV support, part of the EV value chain. So IT also has a lot of choice, but I think you will definitely be safer if you buy into IT for the next 3-4 years. The value erosion chances are much lesser as compared to metals or some other segment that you buy into and then you feel 30% nikal gaya. So that might not happen in IT.
Hemen, from multiple players to just 2 players, pure plays like Bharti Airtel and Idea, and Reliance, which is a diversified company, but majorly inclined towards telecom now. What do you like the most amongst all these 3?
Well, just on a lighter note, I ported from Vodafone to Jio simply because like the WhatsApp messages you go around walking looking for a Vodafone signal. So at least that issue. But yeah, practically speaking, I like Reliance. It's not only a telco, but I think Reliance looks very promising. We've had a decent, if not a significant, retracement. Like you said, not too much to pick and choose. So it would probably be Reliance one, and Airtel would be the second one because it's been almost 2007. So it's been a 13-year consolidation for Bharti Airtel. Gitu on technical parameters, large range between 200 on the downside and 540 on the upside. That is now part of history. We went to 610, came back to 400, went back to 620. So when we get out of this prolonged consolidation phase, I term this consolidation because it looks like a rounding bottom, which is basically a bullish formation. Indicators only the longer term are supporting what I'm telling you. So I believe Bharti Airtel could be a 4-figure stock, but I don't see that happening, at least in the immediate near future. Yeah, probably a year or 18-month point of view. So little to choose, but it'll be Reliance and Airtel. Hito.
Which stocks do you like the most? I mean, three stocks that you would recommend your clients to really put in money right
One, even I have a very obvious preference for pharma. I believe the next at least 3 years from a technical parameter point of view, pharma is going to do well. So I would pick and choose between Sun and Lupin. Both look good, but I'd probably just uh, prefer Lupin because 7 months of consolidation, we've not taken out 1113. When we do, I guess it is going to go through the roof. And if you want a dark horse in pharma, I guess it's Glenmark Pharma. So a lot of underperformance on technical parameters. It has been a bit weak, but I think now it's time for his place in the sun. So Lupin one, and I would say Glenmark Pharma two, and okay, one more stock, but I'll stick to Lupin in the pharma space. Second one would be I like something like a through ICICI that looks very interesting. Though I don't have too much of data to give a very long-term projection, but that looks something very interesting. And I believe probably a Sundaram Clayton on technical parameters looks brilliant. I believe there's a big move coming in expected in the next 6 months or so.
Even one last question from you. How do you expect the rupee to pan out? I say we saw around 2% plus points of weakness in the rupee against the dollar. Is it here to stay for some more time?
Yes. If you give me the liberty, I'll answer your question in two parts. Firstly, the US dollar index. Now, okay, we are not a part of the currency against which the dollar index is measured, but we move contra to the dollar index, which is a bit surprising. Now, the dollar index has been down for 4 weeks in a row, and if I look at the rupee dollar equation, the dollar has been up against the Indian rupee 4 weeks in a row. So there is no clear correlation. But having said that, uh, 75.71 is an important level. I believe we are getting a bit toppish and we should cool off over here. A close above 76 could mean bad times for us. It would affect equity inflows and everything virtually goes out of hand. Only pharma and IT would be the savior then. So currently we've run up for 5 weeks and we are a bit toppish in the near term. So I believe this respite, anticipated respite, like I told you, 75, 71 is important in the rupee dollar equation. If that remains sacrosanct and the dollar doesn't close above that and starts cooling off, I guess, like Prakash says, I guess we'd see renewed FI interest in India, assuming things sort of pan out a bit after the turmoil which we are in. So currently, I won't be too bullish on the dollar, but yes, we've been down for almost what say around 10 months. Where the dollar came down from 77.40 to almost 72.20. Now that's past us. We have a bullish tinge land, and even if the correction which I tell you is on the anvil, the bullish tinge of view or an overhang isn't going away. 73.90 should hold.
Thank you, Hemen. Thank you, Prakash, for your time. It was a pleasure.
Thank you.